Let us move ahead and start attempting questions based on embedded derivative. Let's begin with question number 34. Let us read this question. It says NJ Limited borrows rupees 100 lakhs from a bank on 1st April 2019. Interest is payable at 13% per annum and there is a bullet repayment of principal at the end of the term. Term of loan is 8 years. The loan includes an option to prepay the loan at 31st March each year with a prepayment penalty of 3%. There are no transaction costs. Without the prepayment option, the interest rate quoted by bank is 12% per annum. Required: identify the host contract and the embedded derivative. Determine the carrying amount of the host contract at each year end. Determine the value of embedded derivative at each year end. And lastly, the question is asking you, should embedded derivative be separated from the host? So before we solve this question, we need to analyze this entire scenario. Try understanding this point very well. There is a contract of loan. The company given over here is basically a borrower. So there is a loan contract, and loan contract will give rise to a financial liability. Along with the loan, the company is having an option to prepay the loan. Of course, what will happen, that option will be considered as a derivative. You can check one thing, that option will provide benefit to the company. Just imagine at later stage, here the interest rate involved is 13%, right? And without the prepayment option, the loan could have been borrowed at 12%. Now, if you observe, if the interest rate prevailing in the market declines, what will happen to this prepayment option? Imagine that interest rate in the market declines to just 10% per annum. Then exercising this prepayment option will be worthwhile. The prepayment option will derive value from the changes in the interest rate. If the prepayment option is deriving value because of the changes in interest rate, we will say that the changes in interest rate, or simply interest rate, is the underlying in the contract, and the prepayment option is a derivative because it is deriving its value from the changes in the interest rate. Because this prepayment option is a component of the hybrid contract, which is itself a loan along with a prepayment option, and where you cannot detach this derivative and trade with that or deal with that separately. Without the host contract, this derivative cannot be settled. That is why this prepayment option is definitely a derivative which is embedded to the host contract. Host contract is the loan which is borrowed by NJ Limited from this bank. The loan period is 8 years. So the host contract is a debt instrument or a loan instrument, and the embedded derivative is the prepayment option. So the whole contract definitely is a hybrid contract. The moment we identify that there is a presence of embedded derivative along with a host contract, immediately we need to then talk about the accounting of this embedded derivative. Once you have identified that embedded derivative is present, immediately we switch to the mode of accounting. And when we talk about accounting for this embedded derivative, first thing that comes in mind is about the host contract. Identify the nature of the host contract, because if the host contract is found to be a financial asset or an asset under the scope of Ind AS 109, which is obviously nothing but financial asset, then no brainer applied, no questions asked, the entire hybrid contract will be placed into FVTPL category. In other words, it will be measured at fair value through profit or loss. There is no question of separating that embedded derivative from accounting viewpoint. Look at the nature of the host contract. From the viewpoint of the reporting entity, that is NJ Limited in this case, the host contract is a loan contract where NJ Limited did not give loan, it has borrowed money, and borrowing of money doesn't result into a financial asset, it instead results into a financial liability. That means the host contract over here is a financial liability. Because the host contract is not a financial asset, there is a possibility of separating that derivative from the host contract. So embedded derivative can be separately accounted for. How to do that? We will apply each condition one by one, but first make up your mind that we don't have to put this whole bundle as under FVTPL category. We have to apply those three conditions. Those three conditions will decide whether this embedded derivative should be separately accounted for or should be clubbed along with the host contract and accounted for under FVTPL category. How to deal with this? Let us start applying those conditions, and that is why you should be clear with those conditions. First condition: the economic characteristics and the risk of the derivative is closely related to the host contract. Now see, the economic characteristic of the derivative, which is an option in this case, is not closely related to the host contract. Why? Because host contract is purely a debt contract. That contract, suppose you would not have borrowed money at this arrangement with prepayment option, you would have simply borrowed money, then the bank would have offered you 12% interest. In that case, changes in the interest rate prevailing in the market would have definitely affected you in terms of opportunity losses, but not in real terms. Here, if the market interest rate changes, you directly get impact because of the changes of interest rate. It is not the value of your host contract that is changing, it is the value of embedded derivative that is changing. As a result, there is clear demarcation between the economic characteristics of the host and the embedded derivative. So first condition clarifies one thing, that these need not be clubbed together, they can be separated. But this prepayment option, which is identified as a derivative, though we are not going to separately settle it, but can it fulfill the definition of derivative? That is the second condition. Of course, it is fulfilling the definition of derivative, because I already explained you, it is deriving its value from the value of the underlying. The underlying over here is the interest rate. So if the interest rate prevailing in the market changes, definitely the value of this embedded derivative will change. And the third and last condition is the company going to place the whole contract under FVTPL category? The answer is no. This contract is such a contract where the host is a financial liability which will be measured at amortized cost, and therefore all conditions that are required for deciding whether this embedded derivative should be separately accounted for are in favor of separation. That means you should record the financial liability under amortized cost category, and you should record this derivative under FVTPL category. That separation completely makes sense, and therefore we will go for the separation as a mode. Though the separation part we have to answer at the end, but it is important for you to identify that earlier, because if you don't identify that earlier, then all the calculations that you will make as per amortized cost measurement will be just a wastage of your time and effort, because ultimately if it is not separation, that means if the embedded derivative is not separated from the host contract, the entire hybrid instrument will be placed into FVTPL category, then amortized cost measurement will not come into picture at all. That is why you should first decide whether that separation is going to happen or not. So coming to the measurement part, now here if you closely observe, we will never be in a position to directly assess the value of prepayment option. It is not going to happen, because if you can separately measure the value of embedded derivative, that is the fair value of the embedded derivative, if you can find, then from the entire hybrid instrument you subtract the fair value of embedded derivative and the residual value can be allocated to the host contract. But that's not going to happen in this case, because you cannot find the value of the prepayment option directly. Instead, what you'll have to do is, using amortized cost measurement, you will have to find the value of the host contract first, and from the fair value of the entire instrument you subtract the fair value of the host contract, and that difference will give you the residual value which can be allocated towards the embedded derivative. Now here, because we have no information about changes in the market interest rate, we will consider one singular effective interest rate, that will be 12% per annum. Why 12% per annum is considered as effective interest rate? Because had this contract been purely a debt instrument without any prepayment option, the bank would have offered you 12% per annum interest. Therefore, 12% per annum will be considered as effective interest rate. So as I have already explained you the whole thing, you already know how to make amortized cost measurement, and you also know that from the value of the entire contract, when we subtract the value of the host contract, you get the balancing figure as the value of embedded derivative. Just understand one thing, as and when you get closer to the maturity of this loan, the value of the embedded derivative will keep going to the lower and lower side. In fact, at one point it will start going to the negative side. Why? Imagine that you are trying to assess the value of that prepayment option at the last couple of years when it is left over. What happens at the later stage, when you repay your loan, the EMI or the annual installment, whatever the case may be, that will majorly include the principal repayment, and the little portion will be towards interest. Therefore, if the interest rate changes at later stage, it will not have much of impact, because the time value of money becomes very minute over there. The impact of time value of money will not be that severe. That means earlier years there is a big possibility that prepayment option is viable. At later years the prepayment option may not be viable, unless there is a high fluctuation in the interest rate prevailing in the market. You would not find the embedded derivative gaining that value at the later stages. So how to determine that value? Let us just deal with the calculations now. But before we start with the calculations, of course we have to give the explanatory part in the answer, because we have to explain what is the host contract and what is the embedded derivative. So let us write up that part of the answer over here. So once we have analyzed this entire question, let us see how to write up the answer for the same. Identify the host contract and embedded derivative, if any. That is your first case. So in the given case, host is a debt instrument comprising annual interest payment at 13% per annum and bullet principal repayment at end of 8 years. Option to prepay the debt at rupees 103 lakhs is an embedded derivative. Determining the present value of the host debt instrument. Now here your cash flows from year 1 to 8 and at the end of 8th year will be 13 lakhs every year from year 1 to 8 towards the interest payment, and 100 lakhs as the last year cash flow, that is the bullet repayment of the loan. Then you find the present value factors using 12% discounting rate, because 12% is considered over here as the effective interest rate. Now this typically is the annuity factor computed at 12% discounting rate for 8 years, which will be multiplied to 13 lakhs, and this is the present value factor for 8th year cash flow of rupees 100 lakhs. So respective cash flows will be multiplied to their respective present value factors to obtain the present value of cash flows, and we find that the present value of this entire amount of cash outflow is coming to 104.97 lakhs. Let us move ahead and now we write up the next heading as determining the amortized cost of the host debt instrument and comparing the same with exercise price of the prepayment option. So you just drop this table. I'll explain you exactly what and how the calculation has to be made. So getting started with year 1, the opening balance for year 1 will be the present value of the liability, that is 104.97 lakhs. All figures in this table are presented in rupees lakhs, that you should keep in your mind. Then because the effective interest rate is 12%, we will have accrual of interest at 12% on this 104.97 lakhs, which comes to 12.60 lakhs. The cumulative outstanding will be A plus B, that is aggregate of these two, which comes to 117.57 lakhs, and the cash flow for the year will be 13% of the amount of loan, that is basically 100 lakhs, because bank will charge 13% on 100 lakhs, and that would come to 13 lakhs of interest payment. That 13 lakhs subtracted from the cumulative amount, because this was the cumulative outstanding and 13 lakhs you would have paid to the bank. So the balancing figure will be obviously the amortized cost, and that will be the aggregate of A plus B, and from that you subtract C. So A plus B minus C will give you the amortized cost, and that is 104.57 lakhs. The same will become the opening balance for the second year. You keep doing like that for each of the 8 years, and you would be getting the value of your amortized cost at each year end, which will be the carrying amount of your host contract. Now once you get the carrying amount of your host contract, you would see by end of 8 years, such carrying amount would precisely match with the amount of loan itself, that is 100 lakhs. It has to match because you computed this particular present value using discounting rate of 12%, and then you are adding all the interest accruals also at the same rate. Obviously the amount will match with the amount to be repaid. Now at any point of time you have option to prepay the loan, and that prepayment is with 3% penalty. That 3% penalty on the nominal amount of loan, the nominal amount of loan is 100 lakhs. So the penalty amount will be 3% of 100 lakhs, and that will be 103 lakhs as the amount that you have to repay if you exercise the repayment option. So that comes to 103 lakhs irrespective of which year you talk about. So now imagine you have your amortized cost balance as 104.57, means in your balance sheet you are disclosing a liability of 104.57, but you can square off your liability by just paying 103 lakhs. So if you do that, you end up saving your liability by an amount of 1.57 lakhs in spite of payment of that penalty. So that is the value of your embedded derivative. So what we did, from the value of the host contract, when you are subtracting the outstanding amounts, you are getting the difference between these outstanding amounts and the exercise amount for your prepayment option. The difference between these two will be considered as the value of embedded derivative. Once again I am telling you, for this purpose we have not computed the fair value of this loan, because if the interest rate prevailing in the market changes, we will definitely consider these as your carrying amounts, but the fair value computation will not be at 12%. We have dealt with this kind of questions earlier, where the fair value of the loan component or liability component will change because of the changes in the interest rate prevailing in the market. That thing, as and when it arises, we can work out, and then the value of the embedded derivative accordingly will change. So here we just have to find this as the exercise amount for your prepayment option, and this is the amortized cost. This we have marked as D, this is E. D minus E will give you the value of your embedded derivative, and as I told you, as and when you reach the maturity, the value of your embedded derivative starts declining, and at later stage you will be finding it being expensive to prepay your loan, because prepayment is actually causing a loss to you at later stages, but it is beneficial at the earlier stages. So if the company is having a substantial cash flow at early stages, it can actually repay the loan by exercising its prepayment option. Even after payment of penalty, it will still end up saving a substantial value. But then once this value starts going to negative, the company should avoid exercising the prepayment option. Once again, for your acknowledgement, I am telling you, changes in the interest rate that could be possible, I have not incorporated that. We cannot do that because we have no information about changes in the interest rate, but fair values should always be determined taking into account what is the current prevailing interest rate in the market. Let us move ahead, and now we write the descriptive part of the answer. In this case, the management of NJ Limited determines that the options exercise price is not approximately equal to the amortized cost of the host debt instrument. It will need to separate the embedded derivative and account for it as per Ind AS 109. It may be questioned as to why an option to repay a fixed rate loan early meets the definition of embedded derivative. In the context of a fixed rate debt, it may be interpreted that the option affects the cash flow only if exercised, and the cash flow of a fixed rate debt do not vary with interest rates. Let us move ahead and continue writing further. However, in this context, a variation in cash flows should be interpreted as possible change in the fair value of expected cash flows. Accordingly, the options expected cash flows vary according to interest rates in a similar way as a separate option to purchase a fixed rate debt asset at a fixed price. A fixed price option to prepay a fixed rate loan will increase in value as interest rates decline, and vice versa. I have explained you this point already, that if the interest rate prevailing in the market declines, the prepayment option will increase in value, and vice versa. Let us move ahead and take up the next question, that is question number 35. Let us read this question. NJ Limited, an Indian company, regularly sells solar power panels in local market at price of rupees 4 lakhs. On 1st January 2022, NJ Limited received order from CB Limited, that is an overseas customer, for supply of same type of solar power panels. Expected delivery and settlement will be 30th June 2022. Look at this line, what is given over here. Expected delivery and settlement date will be 30th June 2022. That means the solar power panel is not to be delivered on 1st January. That is the date of placing the order. It will be delivered on 30th June 2022. That is after 6 months from the order date, and the settlement will also happen on the same date. So as on the date 1st January 2022, NJ Limited has just received order from an overseas customer. Neither the delivery has been made nor any payment has been received. CB Limited is placing order only if the price of solar power panel is denominated in USD. For this purpose, NJ Limited needs to provide a quote of the product in USD. On 1st January 2022, the exchange rates were spot rate and 6-month forward rate has been given. Now look at one thing. In this case, NJ Limited is always selling these solar power panels at a Indian rupee value of rupees 4 lakhs, correct? Here the customer has placed a requirement that if you don't quote the price in USD, then we will not place the order. That was the condition for placing the order. So of course, if NJ Limited, an Indian company, needs to take this order as an opportunity for making overseas sales or exports, it should look into what the customer is requiring, and therefore the company has agreed to accept the payment in USD. Now look at one thing, they have given you the spot rate and the 6-month forward rate. You understand one thing, because NJ Limited is not going to receive the payment on 1st January, it is going to receive the payment on 30th June, which is 6 months later. For converting the Indian rupee value of 4 lakhs into a USD amount, that is USD denominated sale price, the reference rate should be the rate which will be the rate applicable on the settlement date. So 6-month forward rate can be considered as an approximation of what would be the rate prevailing on 30th June for USD, which is definitely rupees 80 per US dollar. NJ Limited considers 6 months forward rate as a basis for identifying expected rate of USD after 6 months. So even if this line was not given, it was implied that way. Let us read the question further. Further, the question says, price quoted by NJ Limited, rupees 4 lakhs divided by rupees 80 per dollar, that is $5,000. On 31st March 2022, the exchange rates were spot rate USD 1 equals to INR 79.80 and 3-month forward rate is USD 1 equals to INR 81.20. On 30th June 2022, the exchange rates were spot rate USD 1 equals to INR 82. NJ Limited is required to analyze if the contract for sale of solar power panels to CB Limited contains an embedded derivative and whether this should be separately accounted for on the basis of guidance in Ind AS 109. Also give necessary journal entries for accounting the same. Now in this particular case, how are you going to analyze the whole situation? This is something crucial. Try to understand this point. See, first of all, NJ Limited, the company given over here, is an Indian company. Its functional currency is Indian rupee. Now, the product that it is regularly selling to all its local customers is a particular type of solar power panel. Now, it has received an order from a customer which is overseas customer, and the customer has requested NJ Limited that they will place order only if the company is quoting the price denominated in USD. So what NJ Limited did, it has taken an approximation of what could be the rate prevailing on the payment receiving date, that is after 6 months from now, that was 6-month forward rate, and to collect an amount of rupees 4 lakhs, it has made an approximation at the rate of rupees 80 per dollar and quoted a price for solar power panels in USD as $5,000. Now, the price has been quoted. NJ Limited is not going to receive the amount in rupee value. It is going to receive the amount in US dollar because the settlement will happen in US dollar. Now just imagine what implications will be there. Because NJ Limited is exporting a product, it will receive the money on 30th June and that amount will be converted into Indian rupee value based on the actual rate prevailing on 30th June 2022. Why actual rate? You should consider one thing, NJ Limited did not enter into this forward contract. It did not enter into this forward contract. Forward rate was taken as a reference to make an approximation of the sale price which will be denominated in USD. Now, because NJ Limited is going to receive 5,000 USD, just imagine if the price of USD fluctuates in the market, the cash flow that NJ Limited is going to receive will also get affected. It may get affected favorably, it may get affected unfavorably. Imagine NJ Limited has expected a price of rupees 80 per dollar, but actually on settlement the price of USD was rupees 82 per dollar. That means when $5,000 are received by NJ Limited, and NJ Limited is converting this 5,000 US dollar into Indian rupee value, applying the rate of 82. 5,000 multiplied by 82 will give you rupees 4,10,000. That extra 10,000 what you are getting over and above your expected sale revenue, is it pertaining to the extra amount that your product has fetched for you, or is it pertaining to the price of dollar movement? The obvious answer is it is not your power panel or solar power panel that has got some increase or enhancement in value. It is the price of that foreign currency which increased, and because of the price fluctuation of US dollar you are getting more revenue, and that should not be treated as revenue. When you are talking about revenue recognition from sale of goods, the sale proceeds logically should not be taken as 4,10,000, because 10,000 over there was a benefit of receiving the payment in US dollar. So because of this settlement mode being a foreign currency payment, first of all you identify that there is a presence of embedded derivative. Simple logic. Based on the movement of price of US dollar in the forex market, the total realization in the hands of NJ Limited is going to fluctuate. Can we agree on that? If yes, the receipt or the revenue is fluctuating not because of any other factor but because of the price movement of USD. That means your cash flows are getting affected because of the price movement of USD. That means there is a derivative attached in this contract. That is the embedded derivative. The host contract over here is neither a financial asset nor a financial liability. The host contract is simply the contract of sale of goods, right? The host contract is the sale of goods contract, and to that there is an attached embedded derivative. The nature of this embedded derivative, the risk of this embedded derivative is completely different from the risk of the host contract. Why it is different? See, there is a market for US dollar and there is a market for solar power panels. Now understand one thing, the risk involved in the business of solar power panel or the risk involved in the product as such is not matching with the risk involved in the currency movements. In other words, the risk of the embedded derivative is completely different from the host contract, and therefore we have all possibilities to separate the embedded derivative from the host contract. Now if you do not separate, what will happen? You will overstate your revenue. Overstating your revenue will increase your gross profit. Understand one thing, you never had increased margin for your product. Your sale price in local market did not increase. What is this extra 10,000 that you are recovering? It is because of the currency fluctuation, because of the exchange rate fluctuation. If you are getting this 10,000, isn't it an exchange gain rather than considering that as part of revenue from sale of goods? Now you only decide conceptually, is this extra 10,000 that you are getting in this case, is it pertaining to revenue on sale of goods, or is it your exchange difference which is coming to your pocket as an additional benefit? It is definitely an additional benefit that is coming to you, and that is because of this embedded derivative. So logically also we should separately record this embedded derivative, and the profit arising from that embedded derivative is not part of your gross profit. It should be separately accounted for as a different profit element which otherwise you are not getting in your business. This you are getting not because of your business, this you are getting because the payment was supposed to be received in US dollar. So I hope you are very clear with this matter, that there is presence of embedded derivative and it should be separated from the host definitely. So let us look into how to write up the answer for this question. In your answer or in your solution, you may first mention that based on the guidance given in Ind AS 109, the USD contract for sale of solar power panels entered into by NJ Limited includes an embedded foreign currency derivative due to the following reasons. First point, The host contract is a contract of sale of goods that is not classified as or measured at FVTPL. The embedded foreign currency feature, that is requirement to settle the contract by receipt of USD at a future date, meets the definition of a standalone derivative. USD is not the functional currency for NJ Limited, and solar power panels sold by NJ Limited are not routinely denominated in USD. These are the findings that we have summarized in this given example. You just move ahead and write up further. Accordingly, NJ Limited is required to separate the embedded foreign currency derivative from the host contract of sale and recognize it separately as a derivative. The separated embedded derivative is the expected receipt of USD 5,000 against INR at forward rate of USD 1 equals to INR 80 for settlement on 30th June 2022. Subsequently, NJ Limited is required to measure this derivative at its fair value, with changes in fair value recognized in the statement of profit and loss. Let us move ahead and write the accounting treatment. On the contract date, that is on 1st January 2022, when just the order was received by NJ Limited from its overseas customer, obviously no accounting entry shall be passed. So you just mentioned that no accounting entry on entry into the contract of sale of goods. Fair value change in derivative, that is observed on 31st March. Now look at one thing. On 31st March 2022, you have been given two different rates in the question. One was the spot rate and one was the forward rate for the remaining maturity. Now, because no payments are to be settled on 31st March 2022, the spot rate of 31st March 2022 is completely irrelevant. The rate which is relevant is the 3-month forward rate, because that rate will give you approximation of how much money you are going to receive on 30th June. And we have found that this 3-month forward rate available on 31st March 2022 is not matching with the original estimate of your currency rates at the time of entry into the contract, and that is where the expected inflow is definitely going to change. So what is the impact? You have now the revised rate of USD in the forward market for the remaining maturity of 3 months as 81.2, whereas earlier you have estimated rupees 80. Just look at one thing. Earlier you were expecting to receive 5,000 US dollar at 80 in terms of INR. That is 5,000 multiplied by 80 would have given you the INR receipt, but now you are going to receive 5,000 into 81.2. Now difference between 81.2 and 80 multiplied by $5,000 is definitely not part of your usual revenue. It is part of this gain made because of this derivative asset arising. Therefore, derivative asset should be separated from the host contract, and you will separately recognize this 6,000 as a gain, and you recognize this gain through profit or loss. Now on 30th June, that is on the settlement date, you see what is the spot rate of USD. Now no further forward rate reference is required because that is the settlement date. So at the settlement date, the price of USD quoted in the market, that is in the spot market, has gone to 82. Means your actual receipt is going to be 5,000 multiplied by 82. Now you just understand one thing. 5,000 multiplied by 82 would give you cash inflow in Indian rupee amounting to rupees 4,10,000, whereas the amount of revenue that you should attribute to the sale of goods should be only 4 lakhs. So that extra 10,000 is pertaining to this derivative contract necessarily. So the overall gain arising up to 30th June is 10,000. However, gain of rupees 6,000 is already recognized at the previous reporting date of 31st March 2022. So the incremental gain only now gets recognized on 30th June, that is 10,000 minus 6,000, that is 4,000. Alternatively, you may directly compute 4,000 by taking the previous rate that we have observed for recognition on the reporting date 31st March 2022, comparing that with the spot rate of 30th June. That difference multiplied by 5,000 will also give you the same amount of incremental gain, and that is rupees 4,000. You recognize that gain again through profit or loss. Let us move ahead and look for the recognition of sale of goods on 30th June 2022. Mind it, the sale is not happening at any date other than 30th June 2022. The sale is happening on this settlement date. So you are going to receive a total payment of 4,10,000, that is 5,000 US dollar multiplied by the spot rate on this date, that is 30th June 2022, which was quoted as rupees 82 per dollar. So the total cash inflow coming to your pocket is 4,10,000. Out of this 4,10,000, you have already recognized a separate gain arising because of your embedded derivative, and that gain is amounting to rupees 10,000. That should not be considered as part of your revenue from sale of goods. Therefore, we have a derivative asset already recognized. We will square off this derivative asset over here in this entry. So keep in mind one thing. Prior to this particular entry, there was a debit balance of derivative assets in your balance sheet. Now, by passing this entry, the derivative asset is getting squared off. In other words, this gain you have already recognized. Now, what is to be recognized is difference between 4,10,000 and 10,000 as your revenue from sale of goods. So this will be your final recognition entry on sale of goods. Let us move ahead and take up the next question, that is question number 36. Let us read this question. NJ Limited, an Indian company whose functional currency is rupee, enters into a contract to purchase machinery from an unrelated local supplier, CB Limited. The functional currency of CB Limited is also rupee. However, the contract is denominated in USD. Since the machinery is sourced by the company CB Limited from a US based supplier, payment is due to CB Limited on delivery of the machinery. NJ Limited is required to analyze if the contract for purchase of machinery from CB Limited contains an embedded derivative and whether this should be separately accounted for on the basis of guidance in Ind AS 109. Also give necessary journal entries for accounting the same. Further given in the question, key terms of the contract. So they have given you all the details, the contract or order date given, that is 9 September 2021, delivery or payment date given 31st December 2021, purchase price is USD 1 million and USD INR rate for 9 September for settlement on 31st December is given as 67.8 and on the same date the spot rate is 66.4. Then USD INR forward rate for 31st December is given, that will be for the 30th September and 31st December. So the rate given on 30th September is given as interim reporting date. So it is implied that the reporting company is making interim reports and the interim reporting date has been given to you as 30th September. So both of these are the forward rates for USD INR, but these are rates prevailing at different dates. So this is exactly a similar type of question, exactly similar to the previous question actually. The only difference is here instead of sale of goods, you are entering into a contract of purchase of machinery. And obvious point is the changes in the price of USD should not affect the amount of cost of the machinery that you are buying, because it is not the market of machinery that got affected, it is the market of USD that is getting affected. Therefore, the embedded derivative should be separated from the host contract. Host contract over here is a purchase contract, that is a contract for purchase of machinery, and the embedded derivative involved over here is the contract to settle the payment in USD, in spite of the fact that the functional currency of both buyer and seller is Indian rupee. Anyway, let us see how to write up the answer over here. In your answer, you first mention that based on the guidance given in Ind AS 109, the USD contract for purchase of machinery entered into by NJ Limited includes an embedded foreign currency derivative due to the following reasons. First, the host contract is a contract of purchase of machinery that is not classified as or measured at FVTPL. The embedded foreign currency feature, that is the requirement to settle the contract by payment of USD at a future date, meets the definition of a standalone derivative. Third point, USD is not the functional currency for NJ Limited as well as CB Limited. Therefore, purchase of machinery by NJ Limited is not routinely denominated in USD. Let us move ahead and continue writing further in your answer. Accordingly, NJ Limited is required to separate the embedded foreign currency derivative from the host contract of purchase of machinery and recognize it separately as a derivative. The separated embedded derivative is the expected payment of USD 1 million, or you can call it USD 10 lakhs against INR at the forward rate of USD 1 equals to INR 67.8 for settlement on 31st December 2021. Subsequently, NJ Limited is required to measure this derivative at its fair value with changes in the fair value recognized in the statement of profit and loss. Let us move ahead and continue writing further. The accounting treatment. On the contract date, that is 9 September 2021, as no delivery has happened, neither any payment has happened, only one thing happened on this date, that is the contract was signed, the contract was entered into by both the companies, and that means this is basically the date of placing the order. So no accounting entry for entering into the contract of purchase of machinery. Now the fair value changes in the derivative on 30th September will definitely be accounted for. And do you notice one thing, that the price of USD has declined, which is a benefit to the buying company, that is NJ Limited. So it will again recognize a derivative asset of rupees 3 lakhs. How we got this 3 lakhs? The foreign currency amount is USD 10 lakhs or USD 1 million, which is getting multiplied to the difference between the original considered rate for the purchase of machinery minus the rate now prevailing for the remaining maturity of the contract, and that difference multiplied to 10 lakh is obviously going to give you a derivative asset of 3 lakhs, which will be recognized as a gain through the statement of profit or loss. Let us move forward to the settlement date, that is 31st December. On 31st December, first you will recognize the fair value changes, and we identify that further there was a decline in the price of USD, which has now declined to just rupees 67. So as I told you, there may be two different ways of computing this. You compare 67 and the previous rate of 67.5 and multiply that differential of 0.5 to 10 lakh USD, so that the total gain comes to rupees 5 lakhs. Alternatively, the original considered rate was 67.8 and the spot rate prevailing now is 67. Thereby, your overall gain is 0.8 per dollar multiplied to 10 lakh dollar, which gives you rupees 8 lakhs as your gain. But out of that, 3 lakhs of gain you have already recognized. So the incremental gain is rupees 5 lakhs. So you record an entry by taking derivative asset debit to profit or loss, that will be by an amount of 5 lakhs. And when you purchase the machinery, don't forget that your overall derivative asset standing in your balance sheet is at 8 lakhs. The cost of the plant and machinery that you are purchasing will be considered as 6 crore 78 lakhs. But the payment moving out of your pocket is only 6 crore 70 lakhs, correct? Therefore, the settlement of the derivative asset that you have recognized earlier will be happening over here. So your final settlement entry on 31st December, once you write, it will be end of this particular solution.